Right now, something unusual is happening in the gold market, and most people still have no idea. Prices are moving fast, supply lines are tightening, and traders across the world are quietly preparing for what could become one of the most explosive gold rallies in years. But here's the strange part. The warning signs are already visible. Rising tensions in the Middle East, pressure building on the US dollar, and a sudden shift in physical gold supply coming out of Dubai are creating a perfect storm. If these pieces keep moving in the same direction, the gold market could enter full panic mode. And if you hold gold, invest in it, or even just follow global markets, what's happening right now might affect you sooner than you think. Before we break everything down, if you enjoy deep insights into gold, silver, and global financial shifts, make sure you hit the like button and subscribe to the channel. On Bullion Breakdown, we explain the forces behind the precious metals market in a simple way so you can understand what's really happening before the headlines catch up. Now let's start with the first trigger that has traders paying very close attention: geopolitical tension. Whenever global conflict starts escalating, gold tends to react quickly. It has always been seen as a safe haven. Investors run toward it when uncertainty rises. Over the past few weeks, tensions connected to Iran have started heating up again. Military movements, political warnings, and economic pressure between major powers are creating the kind of environment that historically pushes investors into protective assets. Markets hate uncertainty, but gold thrives in it. And even the possibility of escalation can push institutional investors to start increasing their exposure to gold. But this situation goes deeper than just conflict headlines. Energy routes in the Middle East are some of the most critical arteries of the global economy. If instability spreads in that region, it can disrupt oil flows, shipping lanes, and trade routes. When that happens, inflation risks climb. And when inflation risks climb, central banks and investors often increase their gold holdings as protection against currency instability. Now add the second factor into the equation: pressure on the US dollar. The dollar has dominated global trade for decades, but cracks are slowly starting to appear in that dominance. Several large economies have been exploring alternatives for international trade settlements. Some are increasing gold reserves instead of dollar reserves. Others are signing bilateral trade agreements that bypass the dollar entirely. While the dollar is still extremely powerful, even small shifts in global demand can ripple through financial markets. And when the dollar weakens, gold often rises. That relationship has been observed for decades. Gold is priced in dollars globally, which means when the dollar loses strength, gold becomes cheaper for buyers using other currencies. That tends to increase demand. Over time, that demand can push prices significantly higher. But the most surprising part of this story is something happening far away from political headlines: the physical gold market in Dubai. For years, Dubai has been one of the most important hubs for physical gold trading in the world. Huge quantities of gold move through the city every single day. It acts as a bridge between mining regions in Africa, refineries in Asia, and buyers across Europe and the Middle East. The flow of gold through Dubai helps balance global supply and demand. Recently, traders have started noticing something unusual. Supplies moving through the region appear tighter than normal. Premiums for physical gold have been fluctuating in ways that suggest demand may be quietly rising faster than supply. When the physical market starts tightening like this, it can signal deeper changes happening behind the scenes. You see, the gold market actually operates in two worlds at the same time. One is the paper market, where futures contracts and derivatives are traded on major exchanges. The other is the physical market, where real bars and coins move between vaults, banks, and buyers. Most of the time, these two systems stay balanced. But when physical supply starts getting tight, the balance can shift quickly. If demand for real physical gold accelerates while supply struggles to keep up, the price discovery process can become unstable. Traders who normally rely on paper contracts may suddenly need actual metal for delivery. That's when volatility can spike. Dubai plays a key role in this because it's one of the fastest-moving physical gold trading centers on the planet. If supply disruptions happen there, it can ripple through the global system very quickly. Large wholesalers, jewelry manufacturers, and even central banks rely on these supply chains staying smooth. And this is where things start connecting together. Rising geopolitical tension increases investor demand for safe haven assets. Pressure on the dollar makes gold more attractive globally. And tightening physical supply adds fuel to the price movement. When all three of these forces start pushing in the same direction, markets can move much faster than most people expect. Now here's something many casual investors overlook. Gold rallies rarely begin with loud headlines. In fact, they usually start quietly. Institutional investors begin accumulating positions slowly. Central banks increase reserves without making big announcements. Physical demand starts creeping up in major trading hubs. By the time mainstream media begins talking about a gold surge, the biggest players have often already positioned themselves. That's why analysts and traders pay attention to early signals like the ones we're seeing now. Not because they guarantee a massive price explosion, but because they create the kind of environment where big moves become possible. Another factor adding tension to the system is central bank behavior. Over the past few years, central banks around the world have been buying gold at one of the fastest paces in modern history. Many governments are looking for ways to diversify their reserves away from traditional currency assets. Gold offers something unique. It carries no counterparty risk. It doesn't rely on another country's financial system. It simply exists as a store of value. When central banks accumulate gold at large scale, it removes supply from the open market. That alone can tighten availability for other buyers. Combine that with rising investor demand, and the pressure starts building. Meanwhile, retail investors are beginning to notice something else: volatility in financial markets. Stock markets have seen periods of sharp swings, bond markets have experienced unusual stress, and inflation concerns continue to appear in economic discussions. Whenever financial uncertainty increases, gold often starts appearing again in investment conversations. But here's the twist that makes this moment interesting. The gold market today is far more interconnected than it was decades ago. Information spreads instantly. Capital moves across borders in seconds, and large institutional funds can shift billions of dollars into commodities almost overnight. That means if confidence in traditional assets weakens quickly, gold could see a surge of demand far faster than in past cycles. The combination of geopolitical tension, currency pressure, and physical supply shifts could act like dry tinder waiting for a spark. This doesn't necessarily mean prices will skyrocket tomorrow. Markets are complex, and many forces compete with each other. Interest rates, economic data, and central bank policy all influence gold as well. But experienced traders understand that markets often move the most when multiple pressures build quietly at the same time. Right now, that's exactly what seems to be happening. Think of the gold market like a tightly wound spring. Each new development, a political escalation, a currency shift, a supply disruption, winds the spring a little tighter. Most people barely notice while it's happening. But once the tension reaches a certain point, the release can be sudden. For investors watching closely, the key question isn't just where gold is today. The real question is whether these pressures will keep building over the coming months. If geopolitical risks expand, if the dollar faces additional stress, and if physical supply hubs continue showing signs of tightening, the conditions for a major move could strengthen. And if that happens, the reaction from global investors could be powerful. Pension funds, hedge funds, sovereign wealth funds, and retail investors could all begin increasing their exposure to gold simultaneously. That type of synchronized demand is what historically drives the biggest rallies. But there's another psychological element at play in markets: fear of missing out. Once gold starts moving rapidly, media coverage intensifies. Headlines begin talking about record prices. Suddenly, investors who ignored gold before start rushing in because they don't want to miss the trend. That wave of emotional buying can push prices even higher in the short term. Experienced investors try to watch the early signals before that stage arrives. And that's exactly why developments like Middle East tensions, currency shifts, and supply movements in major trading hubs are getting attention right now. At Bullion Breakdown, our goal is to follow these signals carefully and explain what they could mean for the precious metals market. Not with hype, but with clear analysis so viewers can understand the forces shaping gold prices around the world. Because the truth is, gold isn't just another commodity. It's a reflection of global confidence. When trust in political stability, currencies, or financial systems begins to weaken, gold often becomes the asset people turn to for security. And the more uncertainty grows, the stronger that demand can become. So the real question for the months ahead is simple. Are we witnessing the early stages of another major gold cycle? Or will these pressures fade before they trigger a bigger move? That's exactly what makes this moment so interesting to watch. If you found this breakdown helpful, let me know your thoughts in the comments. Do you think gold is preparing for a major breakout? Or do you believe the market will stay stable? Your perspective is always interesting to hear. And if you know someone who follows gold or invests in precious metals, share this video with them so they can see what's developing in the market right now. Thanks for watching Bullion Breakdown. and I'll see you in the next one.